Welcome, everyone. Today, I'm putting on my professor hat, and we're going to examine what might literally be the largest IPO in history, the SpaceX IPO. We're looking at a $1.75 trillion event. And honestly, this is a masterclass in market mechanics, risk analysis, and ultimate wealth creation. So let's just jump right in.
Imagine, for a second, a single company worth more than the entire gross domestic product of Australia. Just let the sheer gravity of that number sink in for a moment. For over a decade now, SpaceX has been the great white whale of private equity. And while most everyday investors were, casually debating real estate versus legacy tech stocks, Elon Musk and his team were quietly building a massive $1.75 trillion financial moat right in plain sight. This scale, it fundamentally alters the whole ecosystem of public markets.
So, here is our syllabus for today's explainer. First, we'll cover the macro catalyst. Second, the structural mechanics of the market. Third, the cash flow snowball. And finally, consistency over speculation. All right, let's start with section 1, the macro catalyst, or what I like to call the $1.75 trillion event. You see, most IPOs are really just venture capital exits, early investors simply cashing out. But an event of this unprecedented magnitude, it's fundamentally different. As an analyst, I see this as a structural shift. When a company this massive goes from private to public, it completely blurs the lines between private and public equity. More importantly, it creates this intense gravitational pull that will eventually force every major index fund to buy in. It literally displaces legacy leaders in the index. When we contrast your standard legacy tech exits with this new space-to-public moat, the underlying equation changes entirely. SpaceX isn't just selling hardware or rockets. They are securing recurring global revenue. Think about Starlink's subscriptions. It's on a scale that disrupts the very nature of index investing. It transforms what looks like an unpredictable tech venture into a massive, globally scaled utility.
Moving right along to Section 2, Structural Mechanics, specifically focusing on the rising rate era.
This brings us to a really vital question, and as an analyst, it's one we have to ask. Critics will rightly wonder if a forced index fund buy-in creates an artificial bubble. If every passive fund is forced to just blindly allocate capital to SpaceX, are we inflating a balloon that's just waiting to pop? Well, this leads us to question the safety of traditional asset allocation models, especially when the macroeconomic climate is shifting beneath our feet.
To properly evaluate the risk of a market shift like this, we have to study the environment it's happening in, specifically the rising rate era. By definition, this is a macroeconomic period characterized by increasing bond yields. And as any finance student will tell you, when bond yields go up, bond prices fall. This causes textbook subpar performance for your traditional defensive assets.
Now, interest rate eras run in multi-decade cycles. Notice the pattern here. We had a rising era until 1920, a falling era until the mid-40s, a rising era through the 70s, and then a massive falling era from 1975 all the way to 2020. Class, the historical data makes one thing abundantly clear. We have recently transitioned right back into a rising rate environment. And this is where the math gets incredibly real. During textbook rising rate eras, the supposed safety net of the standard 60-40 portfolio, specifically that bond portion, suffers massive capital losses. We are looking at historical drops of over 70% in government bonds during previous rising eras. Even in our current era, starting in 2021, we've already seen drops of over 40%.
So, the absolutely crucial point here is understanding why traditional safety nets fail in these conditions. It's an over-reliance on highly correlated nominal bonds. In simple terms, inflationary pressure absolutely wrecks your fixed income. As the market demands higher interest rates, the value of your older, lower-paying bonds drops like a rock. That traditional flight to quality narrative simply falls apart when rates are climbing. You cannot rely on yesterday's playbook for tomorrow's market.
Okay, let's pivot to Section 3, the cash flow snowball. We're going from the macro view down to the micro. Now, you might be sitting there asking, Professor, how exactly does a global satellite network or a trillion-dollar IPO actually connect to my own financial habits and my weekly paycheck? It's a great question, and the answer lies in the beautiful mechanics of compounding. Time is the ultimate variable in finance. Think about it. Time actually works against your linear paycheck. With average wage increases around 3 to 4%, you're barely outpacing inflation. It's a straight linear path. But time works aggressively in favor of your investments through the geometry of curvilinear compounding. Broad market index returns historically sit around 10 to 11%. So one line inches up, the other curves dramatically toward the sky. Just as SpaceX's global satellite network scales massively through consistent recurring revenue, your personal wealth builds through 3 distinct phases of what we call the snowball effect. Phase 1 is the base, your initial consistent daily contributions. Phase 2 is momentum, where your reinvested dividends start buying you more shares. And Phase 3 is the heavy lifting, where exponential growth totally overtakes your original principal. It's like a giant puzzle coming together piece by piece. The underlying equation here is almost comic in its simplicity. Let's look at a modeled scenario of investing just $35 a week. That's $5 a day. In the first few years, the groundwork feels small, maybe even a bit expensive. But look at year 30. Your total out-of-pocket contribution is just under $55,000, but your projected portfolio value? It approaches $1 million. That is the exact same compounding geometry that turns a private rocket company into a trillion-dollar public behemoth. Which brings us to our final chapter, Section 4, Consistency over Speculation.
Listen, here is the stark reality of wealth creation. Out of a theoretical $942,000 portfolio, notice that over $887,000 of that is created entirely by compounding and market growth. It doesn't come from your out-of-pocket contributions. The market is doing the heavy lifting, provided you give it the time and consistency it requires to execute the math.
To capture this kind of growth, especially during turbulent macroeconomic shifts and rising rate eras, like we discussed earlier, you need to look for stability markers. You need broad diversification across thousands of companies. You need exposure to different market cycles, a focus on real historical dividend growth, and extremely low management fees. But above all else, you need a system that prioritizes routine over emotion every single time.
You really have to shift your mindset here. You don't have to outsmart the SpaceX IPO. You don't need to predict exactly when the Federal Reserve will pivot on interest rates. Actually, scratch that. You just shouldn't even try. You just have to measure your success by your consistency rather than week-by-week portfolio growth. You simply have to stay steady long enough to let compounding do its job.
I want to leave you with this stark warning from financial author J.L. Collins regarding inevitable market corrections. He says, "Here's the one thing that will determine whether the market makes you wealthy or leaves you bleeding on the side of the road: what you do when the market drops." It's a profound reminder that human behavior, not sophisticated, highly speculative stock picking, is the ultimate arbiter of your financial success. As the lines between public and private markets continue to blur and trillion-dollar titans enter the public sphere, the data poses one final question for your financial future. Will you harness the mechanics of this structural market shift to build lasting wealth, or will you be left forever reacting to the noise? The math is on the board. The choice is entirely yours. Thanks for joining me in this explainer, and keep learning.
Thanks for watching. If this gave you a new way to think about your wealth, subscribe to Langford Invests. Leave a comment below with the one savings move you're making this year, and I'll see you in the next one.